Welcome to our webinar, Building Your Wealth Advisory Firm's Acquisition Strategy. I'm Bridget Height, host and moderator for Oak Street Funding's webinars and podcasts. Today, we will be discussing the evolving market conditions for wealth advisory firms, how to create a robust acquisition strategy, and the considerations for completing the transaction. Our speakers are Adam Farag, VP of Strategic Market Sales at Oak Street Funding, and Rob Madore, Vice President of MarshBerry. Thank you both for being here today. Let's just jump right in, shall we? So let's start by talking about why you might want to acquire another wealth advisory firm. So Rob, what are some of the reasons someone might want to acquire a firm?
I think that's one of the most challenging parts of acquisition is there's so many reasons, and I'm sure Adam, you've heard them all, just like I have. But I'd say, first and foremost, what I hear most often is it's about improving enterprise value, right? Looking out at the market and saying, wow, if I could just do what these large institutional buyers are doing, imagine what it would do for my value. But it can also be for things like expanding geographic reach.
Yeah.
It can be for expanding the services you're able to provide your clients, or it could just be adding people. Talent is so difficult to find right now. And
this is a thing we've heard a lot lately.
Yeah, and there's kind of the term for it, right? Which I've heard Adam say too, which is acquire. Which is the purpose of going out and finding business, not just for the clients, but also for the people that come with it.
Okay.
Yeah, totally agree with everything there. I think a lot of these guys in the RIA space are figuring out, I might be really good at this, and I've built this entire infrastructure. And now I don't just have to service my own clients and employees. I can welcome, a plethora of different advisors to come join me and again, make 1 + 1 = 3. Another thing I've probably heard from Rob here. But, there's a number of different reasons. I think one of the biggest things in our space right now is talking about succession planning.
Okay, yeah.
You have a lot of advisors. I think the average age is like 61, right? So there's a lot of advisors that are looking to either fully retire or partially retire. So there's all these assets that need to be transferred, whether they're going to be sold to a big aggregator, whether they're going to be sold to a peer in the space. And I think, you have more and more of these transactions taking place every year. So it's figuring out, if you're the borrower, you're the buyer, who am I going to best go after and how can I serve them the best? And what do I have to offer, looking at myself. So I think that's a big thing. Right
now. I think one of the other things is there are a lot of advantages to scale.
Okay.
Right. And I'll just, give kind of a low-hanging fruit, which is custodial referral programs. Right. It's really hard to get into, but it's driven growth for some of the largest acquirers, who were kind of built on it. And so if I'm a smaller RIA or mid-sized RIA, I'm saying, how do I tap into that? Oftentimes it just comes down to scale and the assets you have on platform.
Okay, great. So before someone starts looking for acquisition targets, what should they look at internally to be prepared for success? Adam, I will start with you on this one.
So first thing you have to do is take a look in the mirror. Right. I know that goes without saying, but you got to make sure that your side of the street's clean, both operationally, financially, and as a whole from the business. So, I think kind of what I said earlier, take a look at what am I really good at? What do I have to offer? So many times we talk about, I know we're going to talk about today, how do I separate myself from everybody else? And I think that's figuring out what you have to offer that's better than everybody else.
Sure.
Because there's so many of the same things out there right now. I think it comes down to culture. So take a look at your culture, take a look at what you do really well, and figure out who you want to be in the acquisition space.
I would take it even a step further too and saying, most businesses, when they started, they didn't have in mind that they were going to go out and acquire other businesses or merge with other businesses.
Right,
so I feel that many owners are almost embarrassed when I tell them, hey, the first thing you got to do is, like Adam said, look inside your own organization and start, maybe taking a little more of an institutional approach with how you account for things, how you look at hiring, your operations, instead of maybe like a grab a shiny object here or there. So I think that's when Adam says that rings true for me. And I think anyone that's listening needs to understand there's nothing wrong with going back and saying I didn't have it all figured out when I started this business.
Right.
You've gotten to a great point, and now it's just about improving it and allowing it to go where you want it to go. On that note, I think another thing, if you kind of open the kimono, if you will, is how prepared for scale are you actually?
Okay.
Right, and what do you look that's going to influence who you acquire as well. If you're really well positioned for scale, you might just look at it as clients and try and integrate things in, which we'll talk about in a little bit. But ultimately, are you even capable of scaling?
Right.
For me, really the most important thing, once you kind of figure out what you are, what makes you different, and where you want to go with is why.
Okay.
Like what are you trying to be? Another one of my very overused sayings is, what do you want to be when you grow up as a business?
Yep.
Right. And understanding that what got you here will get you there.
Yep.
And
will or will not?
Will not.
Okay,
will not get you there. You have to change your strategy as you evolve. And when you're looking at acquisitions, I'd say you need to look long and hard in the mirror and understand why you're doing it for your own business. Are you trying to act like an institutional acquirer would? Is this really strategic?
Mm-hmm.
Are you trying to build an enduring firm and find like-minded folks, entrepreneurs that are going to join it and allow you to grow it? Or is this more of I'd call it like a cash flow acquisition, where you're saying, hey, there's something here. I know that if I acquire this business or this book of business, I'm going to have a larger distribution at the end of the year. I don't think there's a wrong answer,
right,
but it is going to really influence not just who you're going after, but how you pay for those deals.
Yeah, that makes sense.
Right, and where you get.
There are differences too, where you have the book versus the business. I think to your point, a lot of these guys start off with a book, right? They've got these group of clients, they started managing, that they grew up in the business, they organically brought on their own clients.
Uh-huh.
So that's a book of business. There's a big difference between a book and a business. Business has different operations, different continuity effects, and certain people that do certain jobs within it to make it function as a whole.
Mm-hmm.
So I think, to your point, is this a bolt-on? Is this a cash flow? Is this like a book of business that you're just going to bring to you and, it's a partial retirement for the seller? Or is this an actual business where you're going to have to find out where the synergies are that you're going to realize? I think that's a big piece of it as well.
Completely agree.
Great advice. So one of the questions that we always get is, what is a practice worth? So Rob, you can touch on valuations and the relative value you're seeing today, perhaps. And to add to that, what should someone consider when valuing a firm?
Sure. Well, what I'd say is valuations are still very high, as Adam and I both know.
Okay.
And probably anyone watching this. The market has certainly shifted a bit. The last 10 years or so, valuations have just continued to go up, as have, structures kind of shifted in favor of the sellers. Correct. They're still really high. When it comes to valuing an individual firm, I think the first realization is that this is a service business, right? That there's a lot of goodwill, and that's typically between either the team in fewer cases, or it's the advisor and their client. And so when you're looking at a wealth management business or retirement consulting business where there's that goodwill, the first thing you want to say is, how tight are the relationships with their clients? Because ultimately that's what you care about. What does the team look like, right? Who's servicing these clients? And then, lastly, what kind of scale do they have in their business?
Okay.
Right? And do I want to actually take that on, or do I want to kind of carve that out and just bring up the clients?
Okay.
Totally.
Anything to add to that?
Agree with all that. In addition, whenever somebody talks about valuation, I always want to talk about structure. So like I always say, you can have structure, you can have valuation, but you can't have both.
Okay.
Right. So I think so many times those, especially in the peer-to-peer transactions, the structure and the valuation go hand in hand.
Okay.
So you have some guys that want to get all of their money up front, sell, move on, be gone within a year after the relationship's transferred. That's the book acquisition.
Okay.
You're going to see a little bit lower multiple there because there's a lot more risk for the buyer up front. And as a lender, that's a big thing that we're coaching our buyers on and our clients is, the more you're going to give them up front, the more that valuation should come down because you're taking a lot more of the risk.
Right.
So when you look and then in the middle and say, Now we're going to give you about half to 70% of the consideration up front, and the remainder to be, over 3 to 5 years or whatever the seller's plans are post-close. That's a way stickier business, right? It's a lot easier to plan for client retention and, folks to stay on and have more of a successful peer-to-peer transaction. I think it's a little different in the institutional space.
Yeah.
Let you touch on that. But
No, I agree. The other thing we didn't cover is some of the strategic elements of it, right? When it doesn't matter if it's a book or a practice purchase or if it's an institutional buyer looking at an RIA. It's what else do they bring, right? Is it CPA? Is it maybe experience in a different client niche, right? So there's a lot of strategic elements to geography, right? Expanding geography.
I mean, the synergies that you can realize can be, great example of why it's okay to pay 10 times EBITDA, where in other cases it might not make any sense at all. So I think no two of these are the same. It's what's this going to look like post-close?
Right.
Are you going to be able to, realize synergies that make it strategic enough to say, I'll pay a really high multiple? And that is the case.
That's just to bring it back to maybe the previous question too, because I think it ties into this, is one of the reasons you have to decide why you're acquiring what you're trying to build is it's going to dictate which avenue you take.
Yeah.
If you're a strategic acquirer, if you're looking to add different businesses that are going to allow you to grow and scale, and they'll be there with you to do it, you're probably going to have to take a page out of the book of a lot of the institutional buyers, right? And you have to think about risk a little bit differently. You have to think about finance a little bit differently because you're going to compete. That you're going out and you're trying to find businesses that are really valuable, and it doesn't matter who the acquirer would be; they're going to be really valuable.
And there's internal acquisitions. You have guys at the same broker dealer that are buying each other's books. That comes with its own kind of risk mitigation, right? So it's just not one size fits all. And I think a lot of times, and we as a lender and you as a consultant in the space get asked, hey, what do you think I'm valued at? And it's like, well, it depends. What are you doing? Right. And I think that's, it's definitely not one size fits all. There's a lot of work to be done. And that's some of the stuff that we really getting below surface level to figure out what the right answer is.
Okay, great. Moving toward developing an actual strategy, there are a number of factors to consider when developing an acquisition strategy, starting with understanding the market. So Adam, what are you seeing in the market in terms of acquisitions?
So just to, kind of build on what we just got done talking about, I think we see everything. So people always ask, and I'm sure they do the same with you when they get on the phone with you and say, what are you seeing out there? Right? So what are we seeing? And I always start with the same sentences, and we see everything.
Yeah.
I see sellers that, want to do a whole earn-out-based deal and just want to go to a larger institutional firm to offer better service to their clients. I see sellers that want all their cash up front and to move on to the next chapter of their life without any, sell and stay idea. That's the bookshelf ends, right? Okay. Most of the transactions take place in between.
Oh, okay.
So what I see mostly is some form of cash consideration up front. Typically 50-60% of the overall value that they're placing on the firm is in a cash consideration up front. Some sort of earnout or seller note or something that's contingent on success of the transaction that's typically from 2 to 5 years post-close.
Okay.
And then if the seller's going to stick around, some sort of rolled equity that they're going to get in the greater firm, right? Okay. Something to incentivize them to grow this thing really well. So that's typically what I see. I think you have to tie in what the seller's plans are post-close to what the transaction is going to look like.
Okay.
So that's kind of what I see out there, and what I tell folks is start with what the seller wants to do post-close and start working backwards.
So I think when it comes to strategy, again, defining the why. If you're a strategic buyer, you really have to pay attention to what the institutional buyers are doing, right? You have to look out and say, all right, why are they paying such high multiples? And the multiples have been really high. Why are they these earnouts? Just to kind of to tie in what Adam said about incenting the owners post-deal based on their vision and their goal. If you're strategic, you want these owners to stay on with you for 3, 5+ years, and you want them to grow the business alongside you.
Yep.
And therefore, you are going to pay a premium for that. And that could be in equity too. It doesn't have to just be in cash considerations. There could be, some stock components of it as well.
Yeah.
If you're opportunistic, right, the risk profile certainly changes, and it's going to be something that's a little more friendly to the buyer.
Yep. And I think you incent based on what you want to see.
Yes.
Right.
Okay.
So what you wanted the transaction to look like post close, you might want the seller to be gone in a certain amount of time because that's your strategy. You're not an acqui-hire buyer. You are I'm going to roll up as many assets as I can because I do really well at taking on new clients and working with those folks.
Okay.
And then you have to structure it as such. But to tie into what else we're seeing out there, I want to touch on this as well. I think with all the market volatility and interest rates jumping 400 or 500 basis points,
Yes.
I think you're seeing the smart buyers really pay close attention to the stress tests they're doing on their deal structures and valuations. Okay, so I think you have structures that are contingent on success of the transaction more than we saw, up until this recent downturn in the market and rates going up. I think you could afford to make those mistakes a little bit easier than you can now.
Right.
Now you have to be really strategic with how you're doing that stuff.
Right. That makes sense.
The only comment I would add on that, which is just to add to what Adam is saying, is there's a lot of opportunity in kind of the acqui-hire model where you bring on owners and staff to grow beyond kind of the four walls that you have today. But the downside of that is people are people. Right, you're acquiring people,
yes,
and people come with their own ideas, and you're acquiring someone else's business.
Yeah.
And at one point in time, whether they believe it at that particular moment or not, it was their baby, right? So you're taking their whatever it may be, right? Their secret sauce that got their business to where it is, and it doesn't matter if it's a $150,000 book of business or it's a $10 million business. Everyone has their secret sauce that made them successful. And so there's very clearly a route where for some people it makes more sense to say, I'm purchasing the clients. I want to transition the owner or some of the people out because it's actually easier to incorporate it into my model.
Yeah. Oh, 100%.
Yeah.
I mean, we've seen it. We have acquirers that we bank that's the deal. They're able to offer different opportunities for those clients, like alternative investments and different vehicles that maybe they didn't have the option for before. And, we all want to say it's about client service and it's about how many meetings you have. And that stuff's extremely important. But what if you provide a better investment product and your clients are just as happy?
Yeah.
It's possible too. What do you see from the institutional buyers right now?
I think your instincts are totally right. Everything that you're seeing, we're seeing, whether it's up market or down market, which is the multiples are high. The interest has never been higher. It's probably just about the same as it always has. However, there's a lot more attention being paid to the structure of deals. I'll just call it overall diligence. Right? And that could be cultural diligence and making sure it's really the perfect fit.
Right.
That could be financial diligence. Right. So there's just a lot more attention being paid. I think, some of the other factors of that too are, if you look back the past few years, we've had a lot of events that have driven people to as a catalyst to do something.
Yes.
And that could be the COVID pandemic.
Right.
That could be just, kind of the influx of capital. There's a ton of capital coming into the space the last few years. And people have to spend it, right? Organizations have to spend it. It could be the anticipated capital gains changes, right? So I think that really drove not only the I don't want to call it rush to make deals, because these are very I'm speaking more in the institutional space. They're very smart investors, really smart investors. But you have a mandate to acquire, then you're going to acquire. And I would just say we've seen a lot more patience and diligence.
I think you have a number of things. All the things that we talked about, market volatility, COVID pandemic. I think you have the average age of the advisor. I think you have interest rates changing. All these things put together, it will tell sellers one of two things. Hey, it's time for me to make a move and, sell or work to move on what I built my entire life building, or it's time for me to go on the offense and try to build my firm as big as I can.
And one other, just to kind of flip it a little bit, because I know a lot of the folks joining us are here to kind of understand what does it mean for them.
Yeah.
I think the question Simon Sinek, the question you need to ask is why are the institutional buyers with a lot of capital, a lot of intelligence, these great teams, they've seen it work, right? A lot of the private equity is kind of going from one investment in the space to another. It could be insurance, it could be financial services. Right? why are they putting more diligence in their processes? Why are they changing their structures? And especially if you're saying, I'm going to be a strategic acquirer, I'm trying to build something where it's a rising tide lifts all boats, better together kind of scenario, you are presenting a different path than a lot of the institutional backed buyers.
I agree.
So how do you stand out in this sea of sameness when you're trying to execute an acquisition strategy?
I'll use the phrase, people buy on emotion and justify on fact.
Okay.
It's not, perfectly applicable here.
Yeah.
But I think it's important to remember that if you are pursuing someone in an acquisition, oftentimes it's the emotion, the connection with that firm that's going to allow it to be successful.
Okay.
Right? We do a primarily sell-side representation for advisors.
Mm.
And one of the things I always say early in the process is, hey, don't fall in love too early. Right? Because at the end of the day, you want to have a nice mix of qualitative and quantitative when you're choosing what could be your forever home.
Yeah.
But for this webinar, given that we're speaking to folks looking to acquire, you can use that to your advantage, right? One of the things that's really hard to compete against is purely quantitative, right? What's your CRM? What's your marketing strategy? So to me, it's really two things. One, that's partially quant, which is how can you help me grow in a way that I can't on my own? Mm-hmm. And this is strategic thinking, not necessarily how to, someone's looking to retire. And the second is culture. How can you show them what it's going to be like on day two?
Right.
Yes.
And that's where you differentiate.
And I'll build on that by saying that I like to take the quant piece and put it on the second half of the transaction. I always say if you focus on the little stuff and the intangible stuff, like what's going to happen if we have an investment disagreement? What's the operating agreement going to say? Whose vote wins? Like no one wants to talk about that kind of stuff. Like, we need to talk about that stuff earlier on. And some of my best acquirers that bank with us, they get that stuff, the culture, all the stuff that nobody wants to talk about up front before the numbers, and the foundation's so strong that when you hit the quant speed bump of my friend got 12 times and you're giving me 7 or 8 or something like that, how do you can't overcome that in the sea of sameness, right? With everybody else, it's difficult to overcome. Yeah. So I think the more you stack in the right direction on the intangible stuff, the easier to talk about the multiples and the math and the deal structure and the valuations going to be.
Adam, what are the financing options available that you're seeing that are the most successful?
So that's the beauty of conventional financing. It's our job to tailor some type of financial debt facility that's going to be more customizable to your firm, right? So you might be doing a partner buyout of a partial deal. You might be doing an acquisition of a $500 million firm that involves integrating a whole team. And I think that the debt facility has to mirror what type of acquisition you're doing, right? Yes. So when you say, what are we seeing? I'll go back to, the transaction itself, being whether or not it's going to be successful or not, saying that, half up front, the other half in some type of earnout or something like that. So I think financing where there's a little bit of debt up front, some equity from the buyer, a seller note, some type of earnout, something that has a little bit of everything are the ones that I see being the most successful.
Okay.
But not to say that there's not options available for a myriad of different things.
Right.
So I'll take this in a slightly different direction. I'll call it semi-parallel, which is first and foremost, make sure the way you're financing your deal aligns with your strategy. What are we trying to do?
Yeah.
Especially for those that are trying to do this more like an institution would, you want to think ahead, right? You don't want to think just in the short term. And certainly the larger you get, the more options you have. But the example I would use is I've got 10 books of business that I could look at purchasing. How do you wrap that all into your strategy? And this is another really important part of it is work with someone that understands your business.
Yeah. So what we're underwriting is your ability to pay for this over a long period of time.
Right.
There's changes in the business. This isn't like going to get a mortgage. And I think sometimes, these are complex finance facilities that we all need to kind of educate our borrowers on. And, that's knowing your partner. That's knowing who you're working with. And
So-
get us involved early. And I know it's probably the same with you guys' business too.
Yep.
The earlier that you're involved, that you can help work through a transaction, probably the more successful you
Oh,
are.
no question.
Same in banking, right? The earlier that we're involved, the worst thing that happens is we get a signed LOI. It's like, hey, we need to close this in 30 days. We might not be able to do that, right? We might say, well, we don't like this. We can do this. And it's like, come to us early, right? That's the partnership, right?
Yes.
Yeah, I agree. It's much easier to, be intentional about your business. It doesn't matter if it's your business, your financials, or your acquisition plans. It's way easier to get ahead of it, even if it's a little bit of short-term pain to get it going, than it is to unwind it.
Yep.
Okay.
At the end of the day, and try and make it work
Not be a bomb in the 11th
way
hour.
down the road, and you're the problem.
Yeah, that's exactly right.
Procrastinate. So in previous webinars, we've had many questions about the makeup of deals and if people are being creative in this economic period. So Adam, what are you seeing from the lending side?
So if you're not being creative right now as a buyer,
Yes.
you're not winning many deals.
Okay.
Right. I think, and that's not a testament of the market volatility or anything like that. I think it's the competition that's out there, whether it's institutional, peer-to-peer. I think you have to find out your why, separate, find out what you're good at,
Yeah,
separate.
Spot on.
It has. It's going to be
Spot
coined
on.
here, but yeah, I think you have to, find a way to illustrate that stuff to your seller.
Yes.
That's big. So, I think to your point, how are you being creative? How you're being creative is how you're telling your story for your firm,
Oh, yeah.
right? To really resonate and get through to your seller.
Mhm.
The better that you are about that, the more creative that you are in that, the more deals I think you're going to win.
Mhm.
Financing's math. So my job's pretty easy when it comes to that stuff. The numbers either work or they
Or they
don't.
don't,
Right?
right.
You can either pay for this through the debt service and the profit from the business you're buying,
Mhm.
or you can't.
Yeah.
So I think you got to get deeper. You got to get deeper than the numbers. Now, we as a conventional portfolio lender that hold our loans here have more flexibility and more creativity in financing. I don't like to loop creativity and financing in the same sentence. That may not be a great idea, but no, we do have more flexibility. Our credit committee sits here in this office,
Yeah.
right? So being the ones that hold the debt, I think we can look at more factors to say, yes, we have a credit box,
Mhm.
but it has soft sides.
So we have covered understanding your firm, the market, and the deals. So Rob, how should someone approach the market? How do they find a target acquisition?
Sure. So I'll bifurcate by what type, what are you trying to build?
Yeah.
But first and foremost, I'd say start small, right?
Okay.
Look for low-hanging fruit.
Mm-hmm.
If you're inside a broker-dealer, maybe they're providing you some support to connect you with other advisors that may be looking to exit or partner up. Go to your reps from different vendors. Could be a
Okay.
custodian, could be a technology provider, could be whoever's providing financing. But I would say first and foremost, start small. What you're building is very important here, because if you're building, again, for scale, like an institutional buyer would, this can very quickly become a full-time job. You have to understand and set expectations, just like I would say at the beginning of representing a potential seller,
Mhm.
right? It's all about understanding the probable and being honest about it. And I think applying that lens to acquisitions, you have to understand you're probably going to lose more than you win. You're probably going to have a pipeline of 100 and only 3 of them are really, truly opportunities. And you have to also understand that you're adding another full-time job to your plate.
Okay.
And if you're going to be successful, you have to invest in it. And that could be hiring, or that could be just doing it yourself and understanding that it's going to take time. If you're being, on the other hand, if you're being an opportunistic buyer, stay low-hanging fruit as long as you can.
Yeah.
Right? Because it does, even if you're doing it that way, you still have to find them.
I think it's one thing we talk about our why, and I've touched on it earlier, but how well you illustrate that why and tell your story to folks that's gonna bring
Sure.
folks to you.
Yes.
We have certain borrowers that start off did a couple of acquisitions with us. Now they have people coming to them because they've told their story so much.
Yeah. Right. So thank you. So now it is time to complete the deal, right? So at a high level, what should be considered? Rob?
So my mind goes instantly to diligence. You have to really understand who you're buying, who's coming into your firm, because as soon as you acquire someone or their book business, they're your clients, they're your people, and it's your reputation, right? So that's the first thing that I go to. The second is integration, right? Earlier we talked about, are you prepared to scale? Well, if you are, that means you've got a lot of systems, processes that you're going to want the acquired firm and their clients to migrate over to, right? And so you have to get far ahead of integration.
Okay.
It's not easy to start with. I will tell you, having worked with a lot of sellers on deals, it's very clear which acquirers have done 5, 10, 15, 20 deals versus this is their first or their second. But I would say it's a really steep learning curve, but once you do it once or twice, you pretty much get the hang of it.
Yeah.
So I'd say just outlining that internally is helpful. And then the other thing is you probably want to communicate that with whoever you're acquiring also, because you want to get ahead of it. The day two is really important.
It goes back to setting expectations too, right? From a lending perspective, like I mentioned earlier, we want to get involved as early as possible, right? If we can watch a transaction evolve and take shape, a lot of these transactions, the way they finish is definitely not the way they started, right? So, for us to kind of follow that evolution to see what caused it to take the shape that it's in, you're going to have a better financing experience.
Sure.
So, I agree wholeheartedly with everything Rob said. There's going to be legal, there's going to be vetting, there's going to be diligence. What's the repaper going to look like? What's integration going to look like? What does day two really mean? From a financing perspective, get us involved. Let us see, what the deal looks like on day one, not on day 30. And, that's my biggest advice for folks that want to, ask about what's important to banks and guys that provide debt is get us involved.
Okay. Thank you all for watching, and as always, we will send a copy of the recording and Rob and Adam's contact information in case you'd like to continue the conversation or learn more. Stay tuned for more content from Oak Street Funding. Thank you.